Let me ask you something honest. When Nvidia was trading at $5, how many of you were actually buying it? When Palantir was sitting at $8 and every analyst on television was calling it a money-losing government contractor with no future, how many of you had the conviction to step in and hold through the noise? Not many, and that is not a criticism. It is just the reality of how most retail investors interact with the market we show up. After the run, we see the 100% gain on someone else's portfolio screenshot, and we feel the regret. We tell ourselves we knew about that company early, but we did not buy. We waited for confirmation that the thesis was right. And by the time the confirmation arrived loudly enough to feel comfortable, the easy money was already gone. And the risk-reward had fundamentally changed. I have spent years studying what early-stage growth stories look like before they become consensus. Before the major hedge funds start filing 13F positions. Before CNBC runs the primetime segment, and every retail investor on Reddit starts posting about it. Before your coworker asks you at the water cooler if you have heard of this company. The pattern that separates a company that is about to reprice dramatically from one that just looks cheap has specific identifiable fingerprints. You need explosive revenue growth that is not just high but accelerating, meaning each quarter is bigger than the last in a way that suggests the demand is structural and not cyclical. You need a policy or regulatory tailwind that is creating demand faster than the existing supply can absorb it. You need a product that has already been validated by the most demanding, most rigorous, most skeptical customers in the world, because those validation events are the proof points that transform a story into a thesis. And you need a stock price that has not yet been discovered by the majority of institutional and retail capital, because once everyone knows about it, the asymmetry disappears. Right now, in May of 2026, I am looking at all four of those fingerprints simultaneously on a single company. A company that currently trades at around $11 a share. A company that just reported 849% year-over-year revenue growth in its most recent quarter. A company whose primary product has been chosen on competitive tenders by the United States Army, a NATO ally through the NATO Support and Procurement Agency, the Japanese Ground Self-Defense Force, the Australian Army, and Ukraine's Ministry of Defense. A company that is sitting on over $350 million in cash after a recent capital raise. A company whose gross margin just went from negative 52% to positive 12% in the span of 12 months, which is one of the clearest signals that a manufacturing business has cracked the unit economics problem and is now entering the phase where scale creates compounding profitability. The company is Red Cat Holdings. The ticker symbol is RCAT on the NASDAQ. And everything I am about to show you is why I believe this is the kind of entry point that Nvidia investors wish they had found in 2020 and Palantir investors wish they had found in 2019. If you are not already subscribed to Wealth Lab, do it right now before we go any further. Because this is exactly the caliber of research I put out every single week. The setups that look obvious in retrospect but are almost invisible in the present moment. The companies that the smart money is quietly building positions in before the rest of the market catches up. Subscribe, turn on notifications, and let's get into why this particular story is one of the most compelling risk-reward setups I have seen in the defense technology space in years. Let me start by explaining what Red Cat actually does, because the business model is more straightforward than the name suggests, and the simplicity of the product thesis is part of what makes it powerful. Red Cat Holdings is a Utah-based defense technology company that designs, manufactures, and deploys AI-enabled unmanned systems for military and national security applications. Their flagship product is the Black Widow, a small unmanned aircraft system, engineered specifically for tactical edge intelligence, surveillance, and reconnaissance missions. In plain language, when a soldier needs to know what is on the other side of a building, a ridge line, or an urban block before anyone walks into potential danger, they launch a Black Widow. The system is compact enough to be carried and deployed by a single operator in a backpack. It is rugged enough to function in the kind of contested, austere environments that military operations actually happen in. It has a secure communications architecture designed to resist jamming and signal exploitation by adversaries. And perhaps most importantly in the current geopolitical environment, every single component of the Black Widow, every circuit board, every piece of software, every element of the supply chain is manufactured in the United States. That last point is not a marketing tagline. It is the foundation of the entire investment thesis, and I want to spend real time on it, because most investors who have heard the RCAT story have not fully internalized why the policy environment makes this company's position so structurally powerful right now. For years, the United States military and allied governments around the world were purchasing drones from manufacturers that sourced components from China. The cost was lower, the availability was higher, the performance metrics looked adequate on a spreadsheet. And then the strategic reality of what that procurement practice actually meant started to become impossible to ignore. When you are operating a military drone with Chinese manufactured components in a contested environment, you have a potential intelligence and security vulnerability that is unacceptable in actual combat operations. The communications architecture, the software layers, the hardware components of a drone built with Chinese supply chain involvement creates exposure that defense officials and intelligence agencies became increasingly unwilling to accept. The United States government recognized this reality and took legislative action. Following the implementation of Section 1709 of the fiscal year 2025 National Defense Authorization Act, the government began restricting foreign-made drone components immediately, significantly reducing competition for U.S. manufacturers like Red Cat. This was not a gradual policy transition with a long runway for compliance. It was a hard line drawn in the sand. If your drone contains Chinese-sourced components, it cannot be used in U.S. government and military applications, full stop. That single regulatory action created an enormous and immediate demand vacuum in the defense drone market that American manufacturers now have to fill, and they have to fill it while also meeting the certification standards that the military requires of any platform it deploys in the field. Red Cat is one of the very few companies that was already positioned to fill that vacuum when the policy took effect. The Black Widow had already gone through the years-long process of achieving full NDAA compliance, winning the rigorous United States Army Short-Range Reconnaissance Program, and building the domestic manufacturing capacity to actually deliver systems at scale. That combination of product readiness, regulatory compliance, and manufacturing capability is a barrier to entry that competitors cannot overcome quickly, regardless of how aggressively they invest. The certifications take years. The supply chain relationships take years. The track record of delivering operational systems to demanding military customers takes years to build. Red Cat built all of that before the policy shift made it valuable, and now the policy has arrived and the market is just beginning to recognize what that means for the revenue trajectory. Now let me walk you through the actual financial data, because the numbers here tell a story that is far more compelling than the current stock price reflects. Go back 2 years and you are looking at a company with modest revenue, negative gross margins, and a product thesis that was still being proven in the field. The investment case at that point was entirely forward-looking, built on the belief that the product was good enough to win military contracts and that the manufacturing operation could eventually reach the scale where unit economics worked. Both of those questions have now been definitively answered, and the revenue data is the proof. In the fourth quarter of 2025 alone, Red Cat reported total revenue of $26.2 million, representing an increase of 1985% from just $1.3 million in the same quarter of the prior year. Full year 2025 revenue was $40.7 million, up 161% year over year. And then the momentum did not slow down heading into 2026. It accelerated. In the first quarter of 2026, Red Cat reported revenue of $15.5 million, representing an increase of 849% from $1.6 million in the prior year quarter. Gross margin improved to 12.7% compared to negative 52.1% a year earlier, and gross margin increased 199% sequentially from the fourth quarter of 2025. I want to stay on that gross margin number for a moment because it deserves more attention than most people give it. 12 months ago, Red Cat had a gross margin of negative 52%. That means for every dollar of revenue they were generating, they were spending $1.52 to produce it. They were manufacturing at a loss on every single unit. That is not unusual for a hardware company in the early stages of scaling production. The fixed costs of setting up manufacturing lines, sourcing specialized components, and building the operational infrastructure for a defense-grade product are enormous, and they do not scale linearly with volume. But the inflection happens when volume reaches the level where those fixed costs are spread across enough units that the math starts working in your favor. That inflection is precisely what the gross margin data is telling you happened between Q1 2025 and Q1 2026. The company went from losing money on every drone it sold to generating positive gross profit on its operations, and the trajectory suggests that number is going to continue improving as volume scales toward the management guidance targets. Management is guiding for $150 to $180 million in full-year annual revenue, with a target gross margin of 30%. To fully appreciate the magnitude of that guidance, you need to hold the historical revenue trajectory in your head simultaneously. In 2024, this company generated approximately $15 million in revenue. In 2025, they generated $40.7 million. And now management is guiding for $150 to $180 million in 2026. If they hit the midpoint of that range, they will have grown their revenue by more than 10 times in the span of 2 years. And critically, this guidance is not the kind of aspirational projection built on contracts they have not yet won or demand they are hoping will materialize. The pipeline of contracted delivery programs already in execution, combined with the manufacturing capacity they have already built, and the 254,000 square feet of production floor space they have already expanded into, gives this guidance a foundation of credibility that most small-cap growth stories at this stage simply cannot match. Now, let me walk through the specific contracts driving this revenue, because the customer list is genuinely remarkable for a company trading at $11. The validation journey for the Black Widow started with the United States Army Short-Range Reconnaissance Program. Winning that contract was the proof-of-concept moment that mattered most, because the U.S. Army procurement process is one of the most rigorous evaluation environments in the world. When the Army runs a competitive procurement and your product wins, it means your technology has cleared a bar that the majority of competitors could not clear. That credibility event opened the door to every international contract that has followed. In March of 2026, a NATO ally selected the Black Widow on a competitive tender with delivery scheduled during calendar year 2026. The contract was facilitated through the NATO Support and Procurement Agency, and each system includes 2 Black Widow aircraft, a ground control station, and other mission-critical components. Red Cat CEO Jeff Thompson said that NATO allies need platforms that are deployable today for use in contested environments, built on secure U.S. supply chains, and able to be manufactured and fielded at scale. In April of 2026, Red Cat disclosed details on the Japan Ministry of Defense contract for 173 Black Widow systems going to the Japanese Ground Self-Defense Force. The award was the result of a competitive acquisition led by Japan's Acquisition, Technology and Logistics Agency, the external bureau of Japan's Ministry of Defense responsible for defense procurement. The systems are being delivered under Japan's fiscal year 2026 defense funding in coordination with Japanese partners. A concurrent contract covers spare parts and training to ensure long-term operational readiness, and the company expects to deepen local industrial involvement through a licensed manufacturing agreement and expanded in-country support capabilities over time. That licensed manufacturing angle is significant because it transforms a one-time procurement into a long-term industrial partnership that creates recurring revenue streams and deepens the relationship with one of the most important defense markets in the Asia-Pacific region. There is also the Australian Army order, making Red Cat's Black Widow one of the very few small unmanned aircraft systems to have been selected by multiple independent allied nations through separate competitive procurement processes. And then there is the Ukraine dimension, which adds a layer to this story that most investors have not fully processed. Red Cat entered a strategic partnership with Spets Techno-Export, a state-owned enterprise under Ukraine's Ministry of Defense, to collaborate on next-generation unmanned and robotic systems, beginning with next-generation uncrewed surface vessels. Ukraine has become the most advanced real-world testing environment for drone and autonomous systems technology in the history of modern warfare. The operational lessons being generated in that conflict about what works, what does not, what makes a drone survivable in a contested environment, and what software capabilities matter most in actual combat are feeding back directly into the product development roadmap of companies like Red Cat in ways that no peacetime testing program can replicate. Red Cat held an Innovation Day in February 2026 that showcased the company's transformation into a true multi-domain autonomous defense platform, with the live demonstration of new unmanned surface vessels operating seamlessly alongside Black Widow drones. Through the acquisition of Apium Swarm Robotics, Red Cat is embedding an autonomy layer that enables swarming behavior, enhancing coordination, survivability, and operational flexibility across multiple simultaneous platforms in future conflict environments. This is the long-term vision that transforms the valuation story from a drone hardware company to something much larger. The endgame is not selling individual aircraft to individual militaries on one-off contracts. The endgame is becoming the platform provider for integrated AI-driven, multi-domain autonomous warfare systems that can coordinate dozens or hundreds of air, surface, and eventually subsurface assets simultaneously. That market opportunity is orders of magnitude larger than the current revenue base, and Red Cat is building the technical foundation for it right now. Now, let me talk about how to think about positioning, because finding the right company is only half the equation, and the other half is managing the position in a way that allows you to actually capture the upside. Analysts covering RCAT carry a strong buy consensus rating with an average price target of $20. Clear Street initiated coverage with a buy rating and a $22 price target, from the current price of around $10 to $11. Those targets imply more than 100% upside from here, if the execution continues on its current trajectory. That is an asymmetric setup on paper. But the risks are real, and I am going to walk through each of them because the worst mistake you can make as an investor is buying a compelling story without a complete understanding of what can go wrong. The most immediate risk is that the company is still generating net losses. Red Cat posted a net loss of approximately $26.55 million in the most recent quarter. They are investing aggressively in manufacturing capacity, product development, and geographic expansion, all of which is appropriate and expected at this stage of the growth curve. But it means the company is dependent on continued access to capital and continued contract execution. If either of those variables deteriorates, the financial position can become uncomfortable quickly. The recent $225 million equity offering came at a price near the low end of the indicated range and roughly 15% below the prior close, creating meaningful dilution for existing shareholders. That dilution math is real, and it needs to be part of your analysis. When you buy RCAT today, you are buying into a share count that is significantly higher than it was 6 months ago. The per-share economics of the growth story are affected by that dilution, and it is something you need to account for in your return calculations. The volatility profile is something you need to genuinely prepare for psychologically, not just intellectually. This stock moves 3 times as much as the broader market in both directions. On a day when the S&P 500 drops 2%, RCAT might drop 6%. When the market rips higher, RCAT can do the same. If you are not emotionally prepared to see your position down 30% before it goes up 100%, you will sell at the bottom and miss the entire thesis playing out. That is not a hypothetical. It is the most common way retail investors destroy the returns on their best ideas. The approach that works for me on names like this is systematic, pre-planned position building. I determine my total target position size first, meaning what percentage of my overall portfolio this idea deserves given the risk profile and the potential reward. I think about the realistic downside scenario, ask myself whether I can hold the position through that scenario without making emotional decisions, and size accordingly. Then I build to my target allocation across 2 tranches. An initial entry at current levels where the risk-reward looks compelling based on the data. A second tranche, either on a meaningful pullback or after a confirmation quarter, where the revenue is clearly tracking toward the guidance midpoint. This approach eliminates the pressure of perfect timing and forces me to stay disciplined around position sizing, which is the variable that actually determines whether a good idea translates into a good outcome. Here is the bottom line. Red Cat Holdings is an $11 stock with 849% revenue growth, a product validated by the US Army, NATO, Japan, Australia, and Ukraine. A mandatory policy environment that has eliminated Chinese competition from the American defense drone procurement market. Management guidance for $150 to $180 million in 2026 revenue, with improving margins, analyst price targets implying over 100% upside, and a multi-domain autonomous warfare platform vision that addresses one of the fastest-growing segments of global defense spending. Most retail investors have never heard of this company. That is not a warning. That is the point. Nothing in this video is financial advice. I am not a registered investment advisor. Everything here is for informational and educational purposes only. Investing in individual stocks involves significant risk, including the possibility of losing your entire investment. Past performance is not indicative of future results. All analyst price targets referenced represent third-party research and are not guarantees of future stock performance. Always conduct your own thorough due diligence and consult with a qualified licensed financial professional before making any investment decisions. Know here's what I want from you. Is CAT currently on your watch list? And if you had to put a 12-month price target on this stock right now, what would your number be and why? Drop it in the comments below. I am going to read every single response, and I am going to pin the most thoughtful, most analytically grounded price prediction at the top of the comments. Not the highest number, not the most optimistic take, the one that shows the clearest thinking and the most honest assessment of both the upside and the risk. Put your number down and show me your work.